Hello guys, welcome to PlaybookFX and welcome to today's lesson. In today's lesson, we'll be discussing liquidity and inducement. Before we proceed, if you like this video, share your comments in the comment section, subscribe and turn on your bell notification so as when I drop a new video like this, you'll be the first to be notified. Let's get right into the video. So what is liquidity? Liquidity simply means money. Price is always targeting or seeking for money in the market. And the reason is because money is the fuel that moves price. This simply means that without liquidity in the market, price cannot move up or down. Now, price moves in three ways. Is that price move up like this, or price move down, which in this case, markets were bullish in this area and market is bearish in this scenario. The situation whereby market is ranging like this, it is not moving up or down, anything. These are periods when there are low or no liquidity in the market to move price. Whether you trade support and resistance, Fibonacci retracement, range theory, SMC, ICT, price is always after our stop losses. Big institution banks are also involved in this game as well, and they are always after our stop losses. The only way we can avoid being targeted is to understand which liquidity price is targeting next and follow price intent. So the question is, where are liquidity in the market or areas where we can easily spot potential liquidity targets? So the first one is recent highs and lows. Recent high and low are those swings, like we had a push up, push down, push up, push down, push up, push down, like this. There's liquidity here, 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 there's liquidity here on the chart. So these are recent highs and lows, both on higher time frame and lower time frame. Now, number two on the list here is trend line. Now, let's have our chart like this. Let's take for instance that price is pushing to the upside like this. Those that trade trend line, this is what they are always looking for. They are looking for first touch, second touch, and they will connect their trend line like this, and they will be waiting for price to come to this their third touch and buy. Every strategy works. Price is targeting everyone's stop loss, even those that trade SMC. In this trend line scenario now, so people waiting for price to do this third touch, then they'll have their entry somewhere around here, having their stop loss like this. So price may run their stop loss, then start going in profit. So in this case, price has targeted their stop loss, and those that are waiting for maybe breakout and retest. Let's take for instance, price did the third touch here and retrace a little bit, they are pushed to the downside. At this stage, price has taken out those that trade trend line. Now, the next people that will be looking for trade now are those that are looking for break and retest. And what will they be looking for? They'll be looking for price to come back to this trend line, test it, and continue pushing to the downside. Now, price may come back and test it, react a little bit, then start pushing to the upside. Now, in this case, what had actually happened? We have a zone here that people are looking to buy and they are looking to sell from. Those that took the trend line got their stop loss taken out at this level here. The break and retest trader also had their stop loss somewhere around here. So price manipulated those two traders and eventually moved in the direction that it wants to actually go to. Support and resistance is having something like this, multiple, maybe double top, double bottom like that, equal lows like this. They'll be expecting something like this to happen. They'll have this as their support zone for price to then come back, continue pushing to the upside. Instead of price respecting something, I'm not saying that support and resistance does not work. It does work, but as an SMC trader, we trade based on liquidity, and we are always looking for when this kind of manipulation happen before we engage in the market. Now, price manipulated this area of support, then started pushing to the upside. Breakout trader as well, they have their confirmation here because price has already broken to the downside. They'll be looking for sell, and the support and resistance also have their entry here. So price ran the two stop losses and price eventually moved the upside. Now the next one we have here is the buy side and the sell side liquidity. Let me remove this one. Let's see, we have something like this. Now, when price is pushing to the upside, price is always targeting this side. We are expecting this high to be taken out, this high to be taken out in an uptrend. Likewise, in a downtrend, we'll be expecting lows to be taken in a downtrend. In the process of price pushing to the upside, price will be taking this is the buy side liquidity. Price is buying from here, taking out this high. This is the buy side liquidity. When price push up to take here, price has taken out buy side liquidity, price has taken out buy side liquidity. In a situation whereby price is trending to the downside like this, price will be taking out lows, lows, lows. These are sell side liquidity. Price is selling from this high and it's taking out this liquidity. Price sold from this high, took out this liquidity. Price sold from here, took out this liquidity. So the next one we have here, we have weak highs and lows. Weak highs and lows are lows or highs that did not break highs and lows. I made a video on market structure. If you are yet to see the video, I'll leave the link in the description. Please go and watch the video so you will understand how to identify market structure. In a situation whereby price is pushing to the upside like this, we are expecting price to take out highs while pushing to the upside, take out highs, push to the upside, take out highs, push to the upside. Now, when price now gets to one extent that after picking out highs, price retraces back down, now fail to take out this high here. This high that price was supposed to take out, this low became weak. If let's say this happened on higher time frame, price was pushing to the upside like this on higher time frame. Now, smaller time frame, price start doing something like this, price start rejecting back down. In this case, it will be a bad idea to buy from here because this now becomes a weak low. The reason why this is a weak low is because it fails to complete its objective, which is to take out this high. Now, price may come take out this low, then maybe price will continue pushing to the upside from there, or after price take out this low, price may continue pushing to the downside. A low that fails to take out a high is regarded as a weak low. Same thing applies to bearish scenario. Price was pushing to the downside, and price get to a stage, instead of price to take out this low, price start giving a bullish move. When price start giving this bullish move here, it is not advisable to start looking for buy from here again. Why? It's because this high here has refused to take out this low. Now this is a weak high. Price may take that high, mitigate something inside here, then continue pushing to the downside, or price may mitigate something inside here, retrace a little bit, and fail again to take out this low. In this scenario, price has completely shifted market structure. This is a weak high because it fails to take out this low. Now, the next one we have here is what? We have internal illiquidity and external illiquidity. Like I said earlier, price is always seeking for liquidity, and price is always seeking from internal illiquidity to external illiquidity. Let's say, for instance, price is pushing to the upside like this, price is pushing to the upside like this, price is pushing to the upside like this. Now let's say, for instance, this is 4-hour time frame. This is a swing high, this is a swing low, swing high, swing low, swing high, swing low, swing high. In my previous video, I explained what internal and external range means. External range is the big picture of market structure. So, and for you to get the big picture of the market, you need to be on higher time frame, maybe 4-hour, daily, weekly. Internal range will be on smaller time frames, and most of the time you see something, a break of structure like this one, higher time frame. And when you get to smaller time frame, you'll be seeing small move like this on the smaller time frame. Now these are the internal range in this structure. These are the internal range. 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 Now, knowing that these are the internal range, price is always coming from external to take internal. Now, what I mean by this is that these are external, these are external, these are external. Even the lows, they are external. The swing lows, the swing guys, they are external range liquidity. Now, you see those minor range inside this move, those are the internal. So after price has taken out external like this, price has to trace back down to take out those internal before going for external again. When we get to the chart, I'll explain better. It is very, very easy, not that complicated. Now, multiple mitigation. Mitigation means when price taps a POI. A POI can be fair value gap, can be supply and demand, can be order block, can be breaker block, can be anything. Let me use this as an example again. Now, price push to the upside, came back to mitigate here. We have something like this again. Mitigation was made here. Mitigation again here. As price is mitigating all this zone, price is mitigating all this low, price is building liquidity below all this low like this. Now, if price is building liquidity below there and price keep pushing to the upside, keep building liquidity, when price refuse to take out this high and start giving some kind of bearish move, price will be looking for areas that are not mitigated for price to buy from. If price is now retracing back to the downside and price is looking for where to buy from, most of the time price will not buy from all these areas that have been mitigated. Instead, price will come, take out all this liquidity here. There's nothing for price to mitigate here again. Price will take everything out. Then look for somewhere below here. Maybe probably there's something below here that price has not mitigated. Price will come, take out all this liquidity, mitigate here, and start giving us another structure. Again, price has taken out all this internal liquidity. Now, the next place for price to target now is now the external liquidity, which is this swing here. Now, this becomes the internal liquidity, while this swing guy becomes the external. Now, fair value gap is simple, it's common. Fair value gaps are those gaps in between candles, like something like this. If you have a candle like this, let me see, we have a green candle here like this, price is in something like this. We have 3 candles. It has to be between 3 candles though. So we have something like this, and we have something like this. Now in this scenario, the gap in between this candle, these weeks, the gap in between those weeks is our fair value gap. Price always seek fair value gap as well as a target, because these are also draw on liquidity. Fair value gap is just that impulsive move when price buy impulsively or price sell impulsively, leaving like little or much gap in between candles. So those areas, there are liquidity resting in between them. If price is targeting almost or everywhere in the market as liquidity, so how will you know where to buy or sell from? The best area to buy or to sell from are protected highs and protected lows. So I'll be releasing another video explaining what protected highs and protected lows. I will be taking it gradually, episode by episode like that. Now, if you like this content and you like to see more, please like this video, leave your comments in the comment section, subscribe to this channel and turn on the bell notification so as when I release a new video like this, you'll be the first to be notified. Thank you and see you in my next video.